Internal Revenue Service IRS tax news. Income ranges for determining IRA eligibility change for 2021. IR 2020-244, October 26, 2020, Washington. The Internal Revenue Service announced cost of living adjustments affecting dollar limitations for pension plans and other retirement-related items for tax year 2021. Notice 2020-76. There's a link to that here, posted today on IRS.gov, IRS.gov. Highlights of changes for 2021. The income ranges for determining eligibility to make deductible contributions to traditional individual retirement accounts, otherwise known as IRAs or IRAs, to contribute to Roth IRAs, IRAs, and to claim that the saver's credit all increased for 2021. Taxpayers can deduct contributions to a traditional IRA, IRA, if they meet certain conditions. If during the year either the taxpayer or his or her spouse was covered by a retirement plan at work, the deduction may be reduced or phased out until it is eliminated, depending on filing status and income. So this can get a little bit confusing when you're kind of mixing this up with work-related retirement plans. It's kind of thought of, as if you have a work-related retirement plan, you kind of want to think of that as your primary tool. You typically might have more benefits with a work-related plan. That would be something like a 401k plan or a 403b plan. And if you put money into those items, it will be tracked for you by the employer to some degree, reported on the W-2 when you get the W-2, and the amount that is if it's a traditional format of a retirement plan for a 401k rather than a Roth. Then it will be taken out of income and therefore not taxable, not included in box 1 of the W-2, and I believe it'll be on box 12, reflecting the amount that you may have put into the retirement plan for something like a 401k plan or possibly a 403b plan for government employees and whatnot. If you don't have any work that it offers a 401k plan, then you have the option. You can put your money into an individual retirement plan, and the traditional individual retirement plan versus a Roth individual retirement plan. If you put money in there, you could still think of it as basically being taken out of kind of like income, because it's kind of like an above the line deduction, or I guess now would be called a Schedule 1 deduction after the law changes and for the look and feel of the taxes when we have the different schedules now. But in any case, but because it's not being pulled out by an employer, then it's kind of like a deduction, but it's like above the line type deduction, a deduction for adjusted gross income. So that's typically the way you want to think of it. Now, if you do have a 401k plan, or if you're eligible to have a 401k plan and whatnot, then you got to get into the weeds a little bit in terms of, are you able to take an individual retirement plan if you already have capability, and or your spouse has capability to take an individual retirement plan. Then you got to check into it a little bit further in terms of your ability to put money into an IRA. But the general thought, you kind of want to think of it as, of course, if you have eligibility to an individual retirement or some type of retirement plan like a 401k or 403b through your employer, that's typically more beneficial. That's typically good. And if you think about the IRS then going, well, what if someone doesn't have access to that? That wouldn't be fair for us not to provide the tax benefit just because the employer doesn't provide a 401k or 403b. Therefore, we have the IRA. So the IRAs there can kind of catch the people that don't have the ability to get this tax savings by putting money into an employer plan. But then what happens if you have both, right? Can you do both? And then you got to take a look at the rules to see whether or not you can do that. Then, of course, the question is, well, how much can I put in to the individual retirement plan under these different kind of circumstances? If it's my only thing that I have, or if I am working with somebody else. And then, of course, there's more complications with the Roth IRA. When might a Roth IRA be more beneficial than a traditional type of IRA or traditional type of retirement plan? Okay, so if neither the taxpayer nor his or her spouse is covered by a retirement plan at work, the phase-outs of the deduction do not apply. Here are the phase-out ranges for 2021. For a single taxpayer covered by a workplace retirement plan, the phase-out range is $66,000 to $76,000. So that's the range, $66,000 to $76,000, up from $65,000 to $75,000 and prior to that. So for married couples filing jointly, where the spouse making the IRA contribution is covered by a workplace retirement plan, the phase-out is $105,000 to $125,000, up from $104,000 to $124,000. For an IRA contributor who is not covered by a workplace retirement plan and is married to someone who is covered, the deduction is phased out if the couple's income is between $198,000 and $208,000, up from $196,000 and $206,000. For a married individual filing a separate return who is covered by a workplace retirement plan, the phase-out range is not subject to an annual cost of living adjustment and remains $0 to $10,000. So that would be for married filing separate. So the income phase-out range for taxpayers making contributions to a Roth IRA is $125,000 to $140,000 for singles and heads of households, up from $124,000 to $139,000. For married couples filing jointly, the income phase-out range is $198,000 to $208,000, up from $196,000 to $206,000. The phase-out range for a married individual filing a separate return who makes contributions to a Roth IRA is not subject to an annual cost of living adjustment and remains $0 to $10,000. The income limit for a saver's credit, also known as retirement saving contribution credit, for low and moderate income workers is $66,000 for married couples filing jointly, up from $65,000, $49,500 for heads of households, up from $48,750, and $33,000 for singles and married individuals filing separately, up from $32,500. Key employee contribution limits remain unchanged. The limit on contributions by employees who participate in a 401k, 403b, most 457 plans, and the federal government's thrift saving plan remains unchanged at the $19,500. So now we're talking about basically the employer side of things, so contributing into the employer. We're talking about if you are an employee and the employer allows you to have some type of retirement plan or provides a benefit of some type of retirement plan, such as a 401k plan or a 403b, 457, we're talking about the limits. Similar kind of concept, but this time it being provided through the workplace as opposed to the individual retirement plan outside of what would be provided by an employer. So the catch-up contribution limit for employees aged 50 and over who participate in these plans remains unchanged at $6,500. The limitation regarding simple retirement accounts, that's SIMPLE retirement accounts, remains unchanged at $13,500. The limit on annual contributions to an IRA remains unchanged at $6,000. The additional catch-up contribution limit for individuals age 50 and over is not subject to an annual cost of living adjustment and remains at $1,000. Details on these and other retirement-related cost of living adjustments for 2021 are in Notice 2020-79, available on IRS.gov, IRS.gov, the IRS website. There's also a link to the Notice 2020-79 here. There'll be a link to this in the description.